I'm excited for this one. Welcome to Masterclass 12 in our series of No Time for Boot Camps for Busy Entrepreneurs. And I'm excited about this one because actually it took a good bit of research. And so we really kind of delved deep into what are some different ways you can use Web3 to raise money for startups, and to generally improve your capital efficiency for startups. There were some really cool case studies in it that we came across. We talked to people within our community and kind of checked things along the way. And in general, I think from a research and an intellectual perspective, it was really fun to go down the rabbit hole and see what people are talking about and what use cases were really out there. I hope you'll get as much out of it as I did, and that this will be hopefully you'll either see confirmation of some things that maybe you heard of in the past, or see some new things that you haven't seen yet. So how do you fund a startup the Web3 way? In the previous class, we talked about the basics of funding a startup the Web3 way, and just as a reminder, that was mostly around building an initial community, which you might do on Discord, on Telegram, or through another social media, on raising some initial funds, either through a private sale or crowdfunding methods, or even by bootstrapping it yourself and bringing that initial money to the table. Then creating an initial smart contract, creating a white paper, usually the white paper before the smart contract, and bringing that to a private sale first, and then a decentralized exchange in order to launch your token. Since initial coin offerings have somewhat fallen out of favor, and initial DEX offerings are seen as more reliable ways to independently launch a token. And we talked about how that full cycle in the end would allow you, with your community, with the DEX, with offering the token at scale, to raise the money to start your startup and do real things, which is what we talked about in the very first presentation of this kind of finance oriented presentation, was how to build a startup that was really worth something. Now we're going to dive into some more complex methods of Web3 fundraising. Again, some of them may feel really familiar. Some of them may feel completely new. Lots of them will have to deal with how you brick together different capabilities within Web3. But all of them are ways of raising money, of making money worth more, of finding ways to make every penny of value count. So the points we're going to cover are the differences between CEXs and DEXs. We'll talk about lending and lending protocols and flash loans, and how that can allow you to do things with equity that you were not able to do before Web3 kind of made it possible. We'll talk about staking, liquidity mining, and yield farming. We had talked about liquidity pools in the context of DEXs, but this will be more from an investment standpoint. We'll talk about IFOs. So in the previous lesson, we talked about ICOs, STOs, and IDOs, which respectively are initial coin offerings, which are kind of more one-on-one or manually done. Security token offerings, which are a more formal and more regulated form of token offerings that kind of parallels traditional share offerings. And then finally, IDOs, which are the most flexible and fastest way to launch a fundraise currently in Web3, with the advantage of the security of a decentralized system, but also the speed of something that can be done a little bit more flexibly. And we'll talk about a full cycle, right? How do you take that basic process that we talked about in the previous lesson? How do we enhance it using various Web3 tools and techniques. Then we'll talk about decentralized insurance and how that can kind of enhance things even more. And finally, we'll talk about some revenue sharing and fractionalization of shares and assets, which may be interesting to you. So just as a reminder, a DEX is a decentralized exchange. And the reason you might use a DEX is that money will both be in the hands of large investors and funds as it is in the traditional world, but you will also be able to cater to retail investors or collectives like DAOs, who will also be able to participate in things that were previously kind of the realm of very large investors. And why is it that a DEX or even a CEX can cater to these retail investors, these small investors, or smaller collectives? It's because the cost of having a contractual relationship between two parties is much lower when you use DeFi. So if you think of previous processes in which you'd have to have a very elaborate contract, where you'd have to have agreements that were signed on paper documents, where you'd have to have lawyers and bankers involved, and escrow accounts, and all sorts of details. Here, all those details are being done programmatically, 24/7, with very low overheads, especially depending on the chain that you use. And so that allows us to do many more transactions around a fundraise than would be possible through traditional methods. And the same is true for a CEX. So in that it was true that a DEX could allow you to have many small participants, a CEX is also able to do that. Typically, a CEX is a little bit more regulated, which can also make it safer, but that also means that to participate, you may have to go through a KYC or a whitelisting process. And we'll explain why in the following bullets. Second thing, in a DEX, fundraising requires the building of digital communities and word of mouth. It's not like you go to a meeting in a beautiful wood floored, marble tabled office and talk to a very select group of very wealthy people. You might need to talk to 10,000 people through AMAs. You might have to build Discord communities. You might have to get people onto your Telegram channels. Some of the complexity around that, as we mentioned before, and please do check out our legal lessons if you haven't already, is that you may not be allowed legally to talk about certain things without going through a more regulated route. And usually those things are around specific value or profits that might be generated from investment. But again, in both a DEX and a CEX, you will have this aspect of building a community beforehand, especially if you can create value for them before you start making asks, is going to be a really good thing, and that applies for crowdfunding as well. Investors will still choose to invest, possibly based off tokenomics and also your marketing efforts. You can get some really big results, not off nothing, but a feeling, off enthusiasm, off hype, but also positive hype and negative hype. But you can also get a lot of interest and enthusiasm based off what your token is actually structurally going to do. So you get people who are really excited about math, will look into your project and see how your token is supposed to work. And then obviously there are the other details of your project, your startup, and the real world impact. In a DEX though, and this is where things start being a little bit different, is in a DEX, your listing, the ability to be listed on the DEX is usually run through a decentralized vetting system. And that system might be no system. It might be that everyone can participate, and then the community just reviews projects in ad hoc forums or on community channels. Or it might be a more formal process where either the DAO, which is a decentralized autonomous organization, which is a group of people who have rights to participate in the governance of a decentralized system. They might vote on which projects to allow to be listed, or the DAO might allocate treasury funds to a professional centralized group that might vet them for them and provide feedback to the community. We've seen some where community participants can receive smaller rewards for reviewing projects and giving kind of several layers of feedback to the community so they can make the best decision. So there's lots of different ways of doing this within a DEX. And if anything we've learned about DeFi is there's always lots of very different ways of doing things. But generally they're going to be decentralized. In a centralized exchange, so that's what a CEX stands for, a centralized exchange, the listing will probably go through a centralized vetting system. And that might be an organization of founders. It might be a professional team that has some sort of remuneration from the CEX in order to review these things. It might be a formal KYC process. But generally, you can expect this in terms of both the professionalism and the centralization, that in a CEX things are going to have a greater requirement. In a DEX, especially a small DEX, you're going to have low to medium liquidity, and investors may be more wary and independent, right? I think many of you have probably seen the acronym DYOR, which is do your own research. And that notion is very true in a DEX because ultimately, because it's decentralized and because there is no one person to blame behind it, except maybe the project itself if they're really engaging in scams or fraud. But there is this mentality definitely in the DEX world that you are responsible for where you allocate your assets, where you put your money. And so generally speaking, investors who are involved in DEXs will be more wary, will want to do their own research, and there will be that burden placed on them to do their own research because there is no one else to blame. And that also means that bigger investors with less time to do their own research or less familiarity with Web3 will not necessarily be present on some of the DEXs, and that means less liquidity. And the direct consequence of less liquidity is usually that when you want to buy or sell, you can get more of what's called slippage, which means that instead of a smooth increase or decrease in price, you might get really big jumps as prices go through the different levels of pricing that people are willing to buy. And it's really important to think of that when you're setting your trades. Most DEXs will offer you kind of a slippage control, which means the amount of increase or decrease in price that you are willing to tolerate as a buyer or a seller. But if you haven't thought of that, or if you're not looking at other types of costs that might be involved, you can have a transaction that is bad, not because of your initial intent or the underlying asset, but because of the liquidity of the market and the parameters that you set into it. Whereas in a centralized exchange, because there's a greater feeling of security, because there are larger investors, there's also usually medium to high liquidity. And there's also someone to blame, right? If there is a centralization of the exchange somehow, then there's someone you can point the finger at to be blamed for bad governance, bad practices, negligence, and all those things. And generally that means that slippage will be less of a factor on one of the large exchanges. Usually because there are fewer large exchanges as well, they will be well covered by arbitrageurs, which we'll talk about shortly. And then the last difference between the two is that in a DEX, and this can be very important to some people, you usually retain custody of your assets. So your money or your tokens are your own, except for the brief moment they're passing through a smart contract. Whereas in a centralized exchange, typically they will have their own wallets, unless they're a non-custodial exchange. And then your assets will be in the CEX's wallets, and they will have custody of them, which allows for round-the-clock trading, which allows for more liquidity, but also exposes you to more risk when you have a negative event, like we might have seen in FTX. Now, it's important to note that even in an FTX style scenario, typically most users will get most of their assets back, but there will be a time during which they will not be available, and that can be kind of a deal breaker for people. So something to keep in mind. And so Just going back, generally speaking, it is easier to get on a DEX than it is to get on a CEX. And so you would see a successful Web3 startup might graduate from a DEX to a CEX in order to access more investors and bigger amounts of funding and liquidity. So here's a reminder on impermanent loss. We touched on it briefly when we were talking about liquidity pools for DEXs in the previous lesson. And so liquidity pools function again by having a pair of two tokens, usually one that represents your startup's token or something that is more rare, and then one token that is more liquid, so a stable coin or one of the major blockchain protocols coins that is easy to trade. And the reason why you have both of those is so that if someone wants to buy your token, they can buy from the pool and you don't have to personally have your wallet attached to it. And then they put stable coins in. That reduces the availability of the token, increases its price, and it reduces or it increases the amount of stable coins in the pool, which decreases their price. And out of that imbalance, usually that provokes people to sell tokens at a higher price and then receive stable coins. So they're self-adjusting systems. And one of the most common formulas that's used to balance out liquidity pools is y times x equals k, where y is the amount of your token, x is the amount of stable coins, and k is a constant that increases and decreases based off the liquidity in the pool. And please do ask questions if this seems arcane. But the most important thing to remember is that when the pool is imbalanced, whatever there is less of becomes more expensive. Whatever there's more of becomes less expensive. And then that formula encourages people to sell what is more expensive, buy what is less expensive, and therefore balance the pool. And each time they do so, transaction fees are given to the people who provided that liquidity, which rewards them for locking their assets into the use of the pool. And so what that means is that if a big trader comes in and suddenly buys a lot of tokens in exchange for a lot of stablecoins, you might get a sudden shift in the balance of the pool. And imagine you could go all the way down to having none of your tokens left and completely full with stablecoins. And at that time, stablecoins are only worth so much. The increase in the value, or sorry, the decrease in the value of the stablecoins would be so much, and then you wouldn't get your tokens back, which are suddenly very expensive. And if you, as the liquidity provider, were to withdraw your share of the pool at that point, there would only be stable coins to get. So you would get stable coins, and you would not get enough stable coins to compensate you for the full value of the pair if it was balanced. And that is called impermanent loss. And it's called impermanent loss because if you waited for people to sell your token and buy back the stable coins, you would regain that value. But during the period of imbalance, you're both getting the most transaction fees, so your rewards are higher, especially if it's switching back and forth, but you will also lose the most from impermanent loss when you have that high volatility. And so it's important to realize that the reason why someone who is participating in a liquidity pool is getting paid is because during a period of time, they may have a choice of either having to leave their assets in the liquidity pool or taking a loss. Again, an impermanent loss if they're willing to wait to the balance. So that's why they get rewarded for it. And different pools might have different rewards. But basically that's an important concept for understanding how these things function. The mechanism by which the pool is stabilized again is called arbitrage. And arbitrage is a term that comes from the traditional trading world. It's a French word. It literally means to referee or to balance between two parties. And an example would be, imagine that you were walking past a physical store, and one of them was an outlet that was selling new clothes, and one of them was a used clothing store. And people were buying a handbag in the outlet that was worth $200. And you looked in the used clothing store and you saw that very same handbag for $100. And you also saw that in the new clothing store, that someone was about to buy that handbag for the $200. So you run into the used clothing store, you buy the the handbag, and you look at it, and it looks like it's brand new. Someone just left this brand new bag. You rush over to the person in the new store. This is usually illegal, by the way, but this is effectively what you'd be doing. You rush over to the person who's about to buy that brand new bag for 200, and you say, I will sell you this perfectly similar bag that I just bought for 190. And so in that circumstance, the person buying from you would gain $10 worth, right? They would buy the bag $10 cheaper, and you would make a profit of $90 minus taxes, minus the energy that you needed to go between the two stores. And that is an example of arbitrage. It's when you spot either manually or programmatically an imbalance of the price of the same thing between two places where you could buy it, and you quickly trade between the two in order to make a profit. In an index sense, that might be, imagine that your token was listed on two DEXs. And because of the way one DEX was trading, or because of different audiences, your token would be listed on one DEX at 50 cents and on the other at 80 cents. You could buy the 50 cents tokens for 50 cents, 51 cents, 52 cents, 55 cents, 60 cents, all the way up until the liquidity moved that price up. And then you could sell them on the other DEX for 80 cents, 79 cents, 76 cents, 77 cents. And on average, you wouldn't capture the entire 30 cents difference, right? You would have to pay fees or transaction fees, and there would be some shift moving to the middle. But eventually, both DEXs would probably stabilize somewhere around 60 or 65 or even 70 cents, and you would capture the difference. That is an example of arbitrage, and there are bots or programs that do this very fast. And that's why liquidity pools on reputable DEXs will not stay imbalanced for long, because someone will see that one DEX pool is imbalanced this way, one is imbalanced this way. They will do the trade really quickly, and they will balance things out. If you are on a smaller DEX or a less known DEX, maybe the arbitrageurs aren't going to be fast, or maybe they don't see the pair and they won't do it. But imagine you see this opportunity, right? You have this situation where there's an imbalance and you can make a profit off buying something low and selling it high, but you don't have the money to make the initial purchase. And that is where a flash loan comes in. A flash loan is a special type of DeFi instrument that will loan you money, no questions asked, as long as the entirety of the transaction is done in one go. So it's a special type of smart contract that you would link into a transaction. And so instead of using your money to buy the token at 50 cents, or even borrowing money and then using it to buy the token at 50 cents, you would put into the smart contract both the money that you wanted to borrow, the transaction to buy the contract at 50 cents, the transaction to sell the contract at 50 cents, and the transaction to repay the loan. And all of that would execute at once. And then it would just give you the product of all that, which is the 30 cents minus fees and slippage. So again, a flash loan is a type of complex smart contract that allows you to program several transactions into one chain of transactions. And it only executes if the whole thing is wound up in one transaction. If at any point in that it stops, then everything unwinds and everything reverts, right? So you miss the opportunity. This can actually be a bad thing. It means that someone with very little money who notices that your DEX or your listing or your SEO is unbalanced could potentially deploy a lot of funds very quickly to basically steal value from you. And that's called a flash loan attack. But it also means that you, with very little capital, could help provide liquidity for many different change. Because at a high level, remember, an imbalance in the liquidity pool is what creates risk for liquidity providers. And liquidity means that more people can buy your token. So you want them to be able to be confident and have less risk. So arbitrage is a good thing as long as it's not exploitative, as long as it's not a flash loan attack. These things can be very good. Obviously, if you use a flash loan, there's got to be something in it for the flash loan provider. So they will probably reduce your 30-cent margin by a little bit. And as always, with all DeFi tools, do your own research. How does a lending protocol work? Let's say that this is not a flash loan situation. It's more of a long-term lending that you need. So typically, a lending protocol will have a similar governance model as a DEX. They will either have a programmed in form of decision making that defines what can be listed, what can be placed as collateral, who can borrow what. Or they will have a DAO, a decentralized autonomous organization in place that will vote on which assets can be taken as collateral, which assets will be borrowed or loaned, and who can participate, and how the different participants will be rewarded for their actions, because one of the core components of any DeFi system is a system of incentives. And so in that, they are very similar to a DEX, right? They're usually a decentralized protocol that has some sort of decentralized voting mechanism. The collateral, so the borrower, the person who wants to borrow, deposits collateral that they will borrow money against. You may scratch your head there and say, well, if I already have collateral, why would I want to give it up and get something else of equal value or even less value, right? Usually you cannot borrow the entire value of your collateral. And the reason is that you may not always have the same instruments to manage a position that you might have in a traditional finance world. So there are no puts or other options available. What a lending protocol allows you to do when you stake some of your tokens as collateral is to retain the position that you're investing in, especially if you expect the value of those assets to increase over time, while regaining the ability to spend the value of those things. Now, the risk that you take is on many lending protocols, you are stuck at a certain value of those assets, right? So let's say that it's 90% of the value of the collateral if that collateral is well established, if it's easily tradable. If it's something that's not easily tradable, maybe it's 50%. And so if the amount that you borrowed, the value of that decreases past that marker, that 90% of what you borrowed, the protocol will typically automatically liquidate your collateral. So they will just sell it to make up for the loss in value. And that is meant to protect the lenders. But it is also a way in which you can lose your position without really having any recourse against it unless you shore up the collateral behind the loan. But so generally speaking, so you will take your asset, your less liquid asset, or the one that you want to maintain, you will lock it in. In exchange, you will receive some sort of fungible token. Again, a stable coin is very popular, or one of the coins from one of the major protocols, could be ADA. And then on the other side of that transaction, you will usually have a lender who is providing the stable coins in exchange for interest on the loan, which again is guaranteed by the collateral with a buffer, so that if there's some sort of decrease in the value of the collateral and it becomes less than the agreed amount, the lending protocol will automatically liquidate that position and repay the lender, so they are not at risk. The interest rates on these can be very interesting. I've seen some that were up to 40% or higher. So that's a lot if you consider that the benchmark interest rate for most people in the world is somewhere around 10% if you're borrowing against the stock exchange index, or even less if you want something safer. And so there really is an opportunity to make a decent amount of money by lending against these things. In terms of repayment, the loan is repaid with interest. There can also be some utility or governance tokens that are distributed to participants, either by the lender or by the borrower, that then will make them a closer part of the lending protocol, or might reward them for their participation and the fees that they've paid into it. How else can you unlock your liquidity? I think in the past year, particularly, although there have been kind of big examples of it all the way back in 2021, the market for real world assets has exploded. What do we mean by real world assets? We mean real things in the real world. So that might be stocks of a company, that might be shares of a company that owns real estate, or the real estate itself, if the jurisdiction allows you to do that. It might be something that's pegged to gold or to other assets. So those are real world assets. And depending on how they're recognized and how they're audited and how they're stored, these might also be things that you could put into a lending protocol and regain the value of, right? So you can have gold in a vault that is typically increasing in value. You can also withdraw a certain amount of stable coins equivalent to that gold and reinvest it or use it. Depending on the reputation and value of an NFT, you can also see a lot of them on NFT exchanges. Some of them may have well-established value. Some of them may have more liquidity, so it's going to be easier to stake a Bored Ape than it is going to be something by an unknown artist or a smaller collection. And like other tokens, these digital assets can be pledged against DeFi loans in order to regain liquidity without selling a long-term position that may have financial or emotional value, right? So the risk for both parties lies in how these assets can be systematically evaluated. It can be hard to understand the value of a piece of property, or maybe you will get a very low amount of collateralization based off that property. Or you may have a system that starts to replicate the traditional finance world, and that includes the traditional finance world's costs. There's other ways to get returns on your unused capital. So let's say that you've managed to unlock some of your token value or your positions, or you've sold tokens and now you have stable coins or even fiat in your account, and it's just sitting there, right? You're not yet using it to run your startup. Then there's three kind of standard ways in which you could get a return on those fixed positions. One is staking. So staking is usually used in proof of stake networks. And what staking is you back a node provider or a validator, as it's called, in exchange for part of the reward or the transaction fee on that network. And it provides decentralized vetting of node providers at the risk of getting slashed. Now, these are all kind of technical terms. I'm going to show you a diagram of how this works in a minute. Liquidity mining is usually for DEXs and particularly for swaps. Again, it's when people participate in those liquidity pools. It provides liquidity in pairs to allow trading around the clock by users, so that the person providing the tokens or the stablecoins doesn't have to constantly be connected to the system. And they receive transaction fees, but they're vulnerable to impermanent loss, as we mentioned. And liquidity mining or being part of a liquidity pool can also be seen as believing in the future of an ecosystem, right? It's usually a long-term thing. You will also see automatic restaking is a really important part of having a liquidity mining strategy, where for participating in a liquidity pool, you will get rewards. And then you can use an automatic restaking protocol to take those rewards and push them back into the liquidity pool. This can be really important for compounding interest effects, and it can be really important if there's a vesting mechanism in the liquidity pool where the longer you are in, the more rewards you receive. Or that the rewards are actually an increased percentage and you want to stake those immediately. We've also seen a couple cool ones the other day. If you want to look at our practical how to launch a DAO on Cardano presentation, we talked about one um, uh, lending protocol called Liquid Finance that actually has an NFT collection. And if you stake the NFT, you get a higher percentage of rewards when lending than if you don't. So it's all really cool stuff. Yield farming is exactly like liquidity mining, except it's far more mercenary. It means that you're not participating in one particular liquidity pool. You're jumping between liquidity pools where the returns are best. And so usually you're chasing volatility, right? So remember the more shifts in the balance of a pool, usually that means more transactions, it means more transaction fees. Once a pool settles down, you can withdraw with less risk, and you're also not getting as many transaction fees, so you should move to the next one. That's what yield farming is. You can do it yourself, like most things, or there are services that provide yield farming as a service. So you can look those up. But basically, you move from DEX to DEX or liquidity pool to liquidity pool, seeking volatility. And that's another way to maximize your return. Again, the percentages you can get on these different things can be quite small, or they can be very large. It really depends, like all things in DeFi, and you should do your research on the combination of risk and reward that you're willing to tolerate. Let's take a zoom in on staking, because I think this is a one that it took me a moment to wrap my head around. So again, staking it happens in a proof of stake network. And what proof of stake means is that the more stake that you have, the more of that chain's tokens that you have locked in, the more the network trusts you to validate, or in this case, to propose transactions. And so the people who provide the nodes, which is hardware, will solicit community members who have tokens to lock those tokens into a stake pool in order for them to be the preferred provider of transaction summaries. And so the more people trust that provider, because you do your research and you realize that these people are reliable, they have good hardware, they don't make mistakes, the more people trust them to lock in their tokens into the stake pool, the more rewards that stake pool operator will get. So you've done your research, you've chosen a stake pool operator on a network, and you lock in your tokens into that stake pool. And usually there will be a lock-in period, right? So you don't necessarily have immediate access to those tokens, depending on the network. In Cardano, which is particular, usually there is no lock-in period for stake pools. So that can be a reason why you would want to be on Cardano more than other networks. But so you pledge your tokens to that stake pool operator, and now they are more likely to be the proposer of a transaction. Then when someone comes along to the network and wants to record a transaction, they pay a transaction fee or a gas fee. And then the chain assigns to on a probabilistic basis based off percentages, the node operators or the validators, the task of regrouping transactions and proposing them to the network. And because you have put your tokens in the pool of your stake pool operator, because they had that greater chance, let's say that they get chosen for this transaction, they propose it to the network, and the other nodes, usually it varies how many, but usually all the other participants in the network will check to see if the transaction makes sense. And they'll just give it a thumbs up or a thumbs down. And based off the percentage of nodes that approve the transaction, often it's just a simple majority, then the transaction will be recorded to the blockchain or not. If the transaction is rejected, because you chose to work with a sketchy node provider, or because they were hacked, or because they did something sloppy on the programmatic side, like they double signed something, or they have conflicting orders recorded in their system, the transaction might get rejected. And typically there's a punishment for that within a network, which is called slashing, which is that, let's say that the stake pool operator has 2,000 tokens locked, and because they had 2,000 tokens, they got the chance to make more of the transaction fee than the others. Then they might see 5% of their entire pool slashed, which means negated by the network. It's removed from them. And so you balance out the rewards that you get as a stake pool participant with the possibility that an unreliable stake pool operator might get slashed. And the slashing might be more than the rewards under the wrong conditions, or your stake pool operator might get banned. And so that's the reason why the system is set up that way, because in a decentralized system, again, there's no one person to check whether a node operator or a validator is reputable. So instead, stake pool participants are expected to do their due diligence and back the ones that are most reputable. Obviously, the amount of reward that the stake pool operator is willing to give you can make people greedy and sometimes back less reputable people, but that's the general idea. If the transaction is accepted, your node provider will typically get a bigger reward than the other nodes. So let's say that you get 30% of the transaction fee or costs, or the gas fee or the success fee. And you are getting that alone as that stake pool operator, whereas all the other validators are splitting the remaining 70%, which is a bigger amount itself, but maybe they're splitting it between 100 different validators. So each validator is getting a smaller amount. And then the stake pool operator will return some of that value to you as a reward. And again, we talked about lock-in periods, doesn't necessarily apply at Cardano, and we also talked about automatically restaking. Can you combine this notion of leverage and the notion of yield? So leverage is when you take your assets and you get more utility out of it, right? So you have a token, you borrow against it, you now have more total leverage than just the value of that token. As we've seen so far in DeFi, one of the most powerful attributes of decentralized finance is composability, and that's the ability to take multiple items of DeFi and bring them together. So they're called primitives, is a DeFi component, and you bring them together into a new product. And Alchemix is a good example. Again, I'm not endorsing these people, do your own research, but Alchemix is a good example of how this kind of composed product. They have created a self-repaying loan, and this is how it works. Like any lending protocol, you deposit collateral, which might be your token from your launch if you've become reputable enough, or you're listed by a CEX, or it might be a less used token that's still reputable enough that you want to get the value back, but you want to hold on to your position. And you receive a stable coin in exchange, let's say up to 50% of the value in the case of Alchemix. Your collateral is put by them into a yield farming scheme, like Yearn Finance would be an example of a yield farming scheme. Again, I am not endorsing them, do your own research. The rewards of the yield farming are used to pay this DeFi protocol a certain transaction fee, and the people who are loaning the amount, but also to pay off your loan. So let's say that you put in something that was worth $1,000, and you got back $500 in your pocket that you can go out and spend. And in the meantime, that $1,000 was placed in a yield farming protocol that had a 10% yield. And so every year you would get $100, and that $100 would go to repay the 500 that you borrowed. And so after 5 years, you would have had the use of the $500, and you would have your original $1,000 back because the loan would have repaid itself. Now, at any point, you could choose to repay that loan, but the idea is just that you're combining these two aspects of a lending protocol and yield farming in order to have a self-repaying loan, which is a new thing. Because your collateral is part of their yield farming strategy, right? they will never liquidate you, or at least that's the claim they make on their website. I could think of a couple situations where maybe they should liquidate you, but it's definitely something to be considered. Here's another form of composability. Can we combine a private sale, liquidity mining, and a DEX listing? And yes, we can. And this is typically what we call an initial farm offering. In an IFO, your initial supporters, so the community that you've built, will buy your token, and that can be in either a public sale or a private sale. And then they will be provided the opportunity to participate in an initial liquidity pool. And when you combine those two things, and so that liquidity pool lives on a DEX, but when you combine those two things, instead of calling it an IDO, it's called an IFO, an initial farm offering. And so they buy your token, they put it in the pool along with a paired stablecoin, and then they receive rewards. Maybe for the IFO, those rewards might be higher than before. And the other benefit kind of for you as a startup is in order to participate, they have to buy your token, right? So you're getting your initial supporters, you're getting your first buyers because they know that they are going to get to participate in this liquidity pool that will have specific rewards associated with your launch, that will be accompanied with a lot of marketing, that might even have some sort of guaranteed buyback or special vesting schedule, or so on and so forth. Both the liquidity and the rewards may be subject to lock-in periods or vesting schedules. It's all kind of defined in the IFO offering. And the thing to remember is that tokenization and DeFi is basically always just a digital representation of a contract, right? So anything that you could model with a contract, you're going to be able to model with an IFO. And then after the initial period, the pool will normally transition to being a normal liquidity pool. And they can choose to continue with that, or they can at that point exit and either keep your token or sell it, or however it needs to be. So IFO participants combine the aspects of being first community members, first investors, and first liquidity providers all into one, and that is through the mechanism that we call composability. So having learned all these things, and having gone through in the first presentation of this kind of DeFi for Web3 startup series of how to go from having a community or having an idea to being listed on a DEX, we can continue that by saying you've been listed on a DEX, you've had some success, you've gotten some marketing, you've gotten listed in the newspapers, you've gotten a much bigger audience, so you need a lot more liquidity. So you go from being on a DEX, you graduate to being listed on a CEX. And so you have to pass a different kind of KYC or vetting process that might be more centralized, but now you're much more reputable. You're in a domain that's probably seen as safer, that has a bigger audience, maybe some more traditional investors. And so because now you're listed on something with good liquidity and pricing, you could approach a lending protocol and say, will you list my token as something that I can deposit as collateral? And so you launched your startup, you launched your token, you listed it, you got some initial funds from selling your token. You probably still have reserves, your treasury tokens or your reserve tokens. You can then place those in the lending protocol and borrow USDT or some other stablecoin against those reserved or treasury tokens. And then you can use the USDT and your tokens to provide liquidity for your own DEX. And so now you're optimizing your raise, you're actually increasing the liquidity on the DEX that you had. And so now you're getting the liquidity rewards as well as the payment for the tokens. Once you finish the next expansion of your company, again, you can unwind that, right? You can take out your tokens and your liquidity from the pool. You can use the liquidity plus the rewards to repay the lending protocol, retrieve your tokens, and do another round of selling, because presumably if you're building something meaningful, the value of your tokens has reached a higher price. And that is how you can have your cake and eat it. You can retain a position, and then you can also regain the liquidity that you would have from that position, which is kind of neat. And again, it's done by using composability to bring different things together. So that was all kind of a cool thing that you wouldn't necessarily see in a traditional fundraising model. Here are a couple additional cool things that you can do in DeFi to kind of push this farther and really optimize. So what if all this goes wrong, right? What if the DEX gets hacked? What if my startup's idea doesn't work? What if I was in ag tech, so agricultural tech, and there's a drought and none of the farmers can afford to pay for my system? Well, decentralized insurance is actually one of the ways to solve this. And it describes a whole range of DeFi, so decentralized finance, implementations of traditional insurance where premiums, investments, and claims are handled in a decentralized way. This includes DeFi-specific insurance. So let's say you're working with a small DEX, or let's say you did your own smart contract programming, and you got it audited by a really cheap provider, which you shouldn't do. You did that. And investors say, well, I don't really trust that this smart contract is going to stand up to security, or I don't like this DEX that you're using. You could offer them to buy into decentralized insurance against a hack or against a smart contract hack or against a protocol failure or a stablecoin depegging or any kind of liquidity or stake pool loss. Or losses from data feeds. So oracles are usually feeds from some sort of system that verifies a piece of real world information or the status of a database. You might insure yourself against a change in regulation, right? Maybe at the beginning of your startup, you were allowed to do a thing. After you were no longer allowed to do a thing, and now you had legal costs that you needed to go through in order to find either a new jurisdiction in which you can operate or restructure your company. Or some other malicious action like flash loan attacks. Under those situations, the decentralized insurance protocol would pay against your premiums as long as you fulfilled the requirements of the claim. Now, because it's decentralized, the claim wouldn't be processed by an insurance processor unless it was delegated by the DAO. There would be a DAO that would vote to handle your claim or not. And so all of these things would kind of be structured programmatically, ideally, where your premiums went into a pool. The pool was then allocated to repay against claims. So you're sharing risk among a group of people according to different things. And this can be a great way to counter what if questions or reservations by investors, especially if you have an investor who is willing to participate, maybe even at a great price, as long as this risk is insured. Decentralized insurance can also meet real world needs. So what we mentioned is that decentralized insurance can respond to a DAO's voting, but it can also be resolved automatically through, again, oracles, which are feeds to the outside world. So imagine that you take insurance against a drought in Central America, or a drought in Africa, or a drought in India. And so you would tie that to temperatures going above a certain level, let's say 30 degrees Celsius or 100 degrees Fahrenheit, and humidity or the inches of rain being below a certain level over a period of time that would qualify a drought. And under those circumstances, you would get paid out. That would be a way to systematically kind of give yourself an insurance that would just automatically be paid out, right? It's not an insurance making a choice to try to make it hard for you. It's just automatic. Either the thing happened or it didn't. And so if you were trying to tokenize carbon credits, for example, and that depends on the carbon absorption rate of managed forest, and suddenly there was this drought and the forest burned, you would no longer be able to get those credits back. But if you used Arbol, which again, do your own research, I'm not endorsing anyone here, you could insure against a negative weather event that might threaten that managed forest. Another example would be if you were running a decentralized travel startup that I was talking to recently, and your customer experience depended on kind of their travels going well, you could use ether risk to insure against flight delays. So imagine anytime a flight is delayed more than 2 hours, your people get paid. They don't have to call EasyJet, or they don't have to get on the phone with the travel agent. Just automatically get paid to their wallet, and then you ensure customer satisfaction. So that can be kind of some cool ways to use parametric insurance to ensure aspects of your business and make sure that they go well. And then another thing that we'll talk about is revenue sharing and fractionalization. So by using tokens instead of bearer bonds or shares, you would, not bearer bonds, just bearer shares. You would be able to sell smaller parts of things, and that could be either legal entities, but it could also be the assets or different parts of your business. Basically anything that you could put into a contract, you can tokenize as long as the local law allows you to do it. And so, for example, you could split instead of just using a share, you could split the tokens into governance tokens, into utility tokens, into security tokens, and into revenue, right? One which would be based on making choices for the company, one that would be based on receiving privileges from the company, one that would be based on being able to buy and sell based off the value of the company, which is usually tied to governance, but not always. You can have non-voting shares. And then one of them might be linked to revenue, right? To get a certain percentage of revenue or a certain percentage of profit. And so that would allow you to sell different aspects of your business or activity to different audiences who are most interested by them, and therefore would pay a premium for them. You could also split a company based off activity. So let's say that you had an office in Switzerland, where we are, and part of that office interacted with the US, part of that office interacted with the UK, part of that office interacted with Japan. You could actually split the revenue share on those different markets based off the stakeholders. Anything is possible as long as it can be written into a contract. You can also peg those tokens to assets. So for example, you could tokenize a taxi, and therefore people would fund the purchase of the taxi, the purchase of the medallion, maybe the maintenance fees on that taxi. And in exchange, they would receive dividends or some sort of revenue share payment from the funds that taxi generated. Same would go for a rental home or an Airbnb or some sort of revenue producing asset, where owning the asset can also be linked to some sort of revenue produced by the asset independently of the rest of the business's activity. Some closing notes on financing for startups. Fundraising and finding liquidity are continuous tasks for any founder, and that's true in the traditional world or in Web3. I think any Web3 founder is looking at their token price. Any non-Web3 founder is constantly trying to find out where the next funds are going to be, unless they have a really, really solid business that just passed that point of acceleration and scale. In either case, it does start with who you know, right? You either need to meet investors or meet strategic investors, strategic buyers, or you need to build a Web3 community, and those are essential steps no matter what path you take. You should always start earlier than you think you should. I think the last moment that you want to be asking for money is when you really need it, because then people are going to be able to squeeze you. And you really shouldn't be asking people for money at all. You should want to be in a position where people want to buy into your venture and are therefore they are trying to buy you. You are not trying to sell to them. And that's really important. The traditional world can be seductive in its offer of kind of a single investor or group of investors with a silver bullet. You know, here's this accelerator, here's this VC investment. You're going to get all the funding that you need, and we're going to go for the next 5 years and build something. But remember, there's no such thing as free money. And today it can be really hard to find those single investments. I mean, the free money's gone, unless you're in AI and doing something really funky. But I'd say anyone who's in quantum, which is still too soon, and anyone who's in blockchain, which has become a little bit too mainstream, you're going to have a hard time finding that single investor unless you have a really, really solid real world use case. Web3 financing gives you more different ways of accessing and optimizing your liquidity. but the rule on free money being a trap still does apply. So when you see high percentages, when you see easy things, remember to do your own research, and remember it might be a trap. Composability allows most DeFi mechanisms to be combined, like building blocks, especially if you have your own smart contract programmers on board because you're doing a DeFi project anyway. So it's something to look into. But most importantly, remember, while hype and volatility may tempt you to go chasing the latest craze, typically when something has enormous rewards, it has enormous rewards for a small amount of people. And those small amount of people get a lot of publicity, but people don't talk about all the people who lost their shirts doing the same thing. The most consistent way of creating value and creating that life-changing value for not just yourself, but your employees and your investors is to create a solid business that has serious reasons for existing, and do real things. So thanks so much for following this series. This is the last presentation in the Busy Entrepreneurs series. Do reach out to us if you have questions on this, or you felt like we didn't touch on something in particular. This is something that we're really passionate about. And in fact, the company was started on the principle of helping Web3 founders kind of get around the obstacles that were stopping them from doing really cool things in the Web3 space. We're particularly interested in working with ecosystems and helping them grow because we feel like that's the tide that raises all boats. And we're really happy that Cardano has trusted us with both the community and working with the different entities within Cardano, has trusted us with the opportunity to talk about these things and work with the community on this. Please do check out our other lessons. They're all on our Decentral House YouTube account. So that's Decentral, DECENTRAL, House, HOUSE. And we've got lessons on legal, we've got lessons on marketing, and lessons on Web3 finance and traditional finance for startups. You can also reach out to us directly. That's our email address, that's our website, and look forward to seeing you in the Cardano community.